On July 4th, yes, Independence Day, Donald Trump signed into law what he's calling the One Big Beautiful Bill. Now, I've read most of the fine print, I've run the numbers, and I've got thoughts. Now, let's get this out of the way. I didn't vote for Trump. I don't support the politics behind this bill, and I definitely don't support the values it was built on. But I'm a certified financial planner, and my job is to help people deal with what is, not just what we wish it was. So in this video, I'm going to break down what this bill actually does and how it impacts people retiring in 2025 and in the near future. What parts might help you, which parts might hurt, and what you can do to stay ahead of it. So let's get into it. This bill is massive, and it touches everything from taxes and retirement accounts to student loans and Medicare. But here are the biggest changes retirees need to know. Number one, tax brackets extended, but with a twist. So the Trump era tax cuts were set to expire here in 2025. This bill makes many of them permanent, but not for everyone. For higher earners, those tax benefits will phase out gradually. So if you're sitting on a $2 million plus portfolio and planning big IRA withdrawals or Roth conversions, that window may be closing faster than expected. Number two, IRMAA brackets got tighter. So Medicare surcharges, or IRMAA, now kick in at a lower income threshold. So a poorly timed IRA withdrawal could bump your premiums by several thousands of dollars per year. Number three, a higher standard deduction. So the new standard deduction is $31,500 for married couples and $15,750 for individuals, with an extra $6,000 for seniors. So that's a win for many retirees, but it won't offset bigger tax bracket shifts if you're withdrawing heavily from your pre-tax retirement accounts. Number four, capital gains and estate tax changes. Capital gains rates now phase in based on income and wealth. And starting now in 2026, the estate tax exemption jumps to $15 million before dropping back down again in 2030. So if legacy planning matters to you, there's a time-sensitive opportunity, and that number is even higher if you're married. It's literally double. Number five, SALT cap relief. So kind of a little relief here. So SALT stands for is the state and local tax deduction. It was a cap temporarily raised. It was at $10,000. Now they raised it to $40,000, but only for households making under $500,000. So if you're in California or New York or another high tax state, this might help for now, but it could be temporary. And honestly, if you're living in a high income area like the San Francisco Bay Area or LA or San Diego or Manhattan or certain parts of Brooklyn, etc., you're probably making more than $500,000 a year as a joint household. So the selling point of this was, you'll be able to write off all your property taxes again and all that. But ultimately, you won't. If you're making over $500,000, you're not going to qualify for it. Now, my honest take on this bill is, look, I don't love this bill at all. It's messy, it's political. It gives with one hand and quietly takes with the other. There are also many other things that we can talk about aid being cut, Medicaid being cut for a lot of people losing their health care, but I'm not going to get into that. I'm going to speak specifically around how it impacts you financially. So there are a few things here that I can get on board with, that I can support. So the first thing is, now 529 plans, they can be used to pay for professional certifications, including the CFP designation. So I think that's a really good thing. I think you can now use that money for funding careers that you couldn't before. Next is, if you're a small business owner, you get to keep your 20% QBI deduction. And the income threshold was raised for service-based businesses. So this could really be impactful for those of you that are self-employed. Next is, Congress didn't gut retirement accounts or nonprofits, which was originally on the table. Big sigh of relief there, but let's be real. Student loan forgiveness programs were replaced with tighter repayment rules. Another negative is the IRS direct file system was scrapped. So here you go, more money back to TurboTax. Tip and overtime pay were excluded from key payroll protections, and a 1% tax was added to certain international money transfers, hurting immigrant families sending their hard-earned money back to home. And also the new charitable deduction for non-itemizers, it's a measly $1,000 for singles and $2,000 for couples. So this isn't really a retirement bill. In my opinion, it's a Frankenstein tax package loaded with trade-offs. All right, let's jump into a quick case study, right? So we have Dan and Lisa, and they're retiring in 2025. Let me show you what this looks like in real life, okay? So Dan and Lisa are 64 and 63. They're retiring at the end of 2025. Dan's been an engineer for his entire life, and Lisa does part-time consulting. This is their overall financial picture. They have about $1.7 million in traditional IRAs. They have another $450,000 in a taxable brokerage account. They have about $250,000 in Roth IRAs, and they have $100,000 in cash. They plan to delay Social Security until age 70, and they're going to be drawing around $120,000 in retirement income. So here's how we're navigating this bill for this client. So issue number one is future tax increases and IRMA premiums. So without a plan, their required minimum distributions in their 70s would dramatically push them into a higher tax bracket and trigger the phantom tax, AKA the Medicare IRMA surcharges, which would be costing them thousands per year. So what's our move? Well, we're running a multi-year projection. Every single year, we're gonna do a tax projection, and we're gonna do Roth conversions starting now. So while the 22% bracket still exists, okay? In 2025, we're gonna convert 130,000, just enough to avoid pushing them to that new IRMA cliff. Now what that does is that shrinks their future required minimum distributions, and it builds up tax-free assets. Another issue they have is they have appreciated stock in their brokerage account. They had about 120K in unrealized gains, and capital gains rates are set to increase for wealthier retirees. So what we're gonna do is we're gonna harvest about $35,000 of long-term gains here in 2025 and pair it with $10,000 in losses, keeping their net income low and under the capital gains threshold. Plus, what we're gonna do is we're gonna donate some appreciated stock to a donor advised fund to lock in a full tax deduction. Another issue they're gonna face is estate and legacy planning. So now with the estate exemption jumping, we're gonna be exploring gifting strategies and trusts now before that window closes in 2030. So that includes multiple different types of trust and charitable vehicles to support their family and causes that they care about. And what we're gonna do is, the result of all this is we'll have potentially over $220,000 in projected lifetime tax savings by just doing some of these more common financial strategies. We're also gonna be helping them lower their medical premiums in retirement. They'll have more flexibility and control from their Roth balances, and a strategy that reflects their values and legacy goals, not just the tax code. Look, again, I don't support this bill. I don't support the politics behind it, but it's the law now. And if you're retiring this year, the clock is ticking. So you have a short window to make smart, proactive moves before the landscape shifts once again. And this is where working with a CFP, someone who actually understands the tax code, and a CPA, Medicare, investments, and your values, it can change everything for you. So if you're feeling overwhelmed right now, if you're feeling like you want someone on your team, look, you don't have to go at this alone. We can help you figure this out. So again, I offer a free call, if you will. Depending on if it makes sense for us, you can go to my website, wealthbllc.com, and you can book a complimentary initial fit call to see if it makes sense for us to work together. But there's no pressure. It's like us grabbing a cup of coffee, just real talk, real planning, us getting to know each other. And again, you'll be working with me, talking to me specifically, not another advisor. So anyhow, if this video helped you, give it a like, share it with someone who's also retiring soon, and subscribe to my channel if you want some no BS financial guidance to help you retire on your term. So see you on the next one. Thanks for watching. Once again, it's Eric Rodriguez here. If you're looking to get help securing your financial future and you're serious about implementing a wealth plan for your specific situation, feel free to check out my website, wealthbllc.com, to learn more about how I work with clients, how I help them align their resources with their values, and put together a comprehensive plan to help them retire on their terms.